Speculation in financial markets is hard enough as it is, and when you throw in this added layer of the political, with government actions carrying more of a first-tier market-moving influence these days, it gets even tougher. The U.S. administration is front and center when it comes to this area, and predictability is not an easy game when it comes to getting a handle on moves out of the White House. Late Thursday, the market got a healthy dose of this with the president on the wires advocating for a strong U.S. dollar. Clearly, there's a lot of reading between the lines that is required here, and there's a legitimate place, albeit potentially abstract, where the two sides of this can be reconciled, wanting to have a weaker currency for trading purposes to help chip away at the deficit, while ultimately wanting a stronger currency, perhaps once these objectives are achieved, could be the ticket. But it seems there was a lot of heat out there after the Wednesday Mnuchin comments, and perhaps the president realized the soft dollar policy strategy would be better served as it was in 2017, when it proved to be a ruthless, behind-the-scenes effective force without drawing unwelcome attention, as seen this week. But all things considered, given the pace at which the US dollar has declined in early 2018, the market was already looking for an excuse to lighten up on the short dollar positioning, which has been quite aggressive, leaving technical studies well overextended and begging for imminent short-term relief. The ECB meeting did produce a more hawkish than expected tone from Draghi, which has helped to keep the euro bid up, while this week's UK employment data was also supportive of the flying pound, keeping the cable rate elevated. And other things like tweaks to BOJ policy and more encouraging headlines relating to NAFTA and trade have been friendly to the yen and commodity currencies, respectively. And so dollar policy aside, there have been traditional drivers factoring into the dollar weakness as well. But again, we can't help but recognize the overextension here, and this coupled with an equity market that could roll at any moment, the possibility for some more pushback on an appreciating currencies against the US dollar, and risk that a run of positives away from the US move back the other way, all seem to warn that a dollar recovery of some form could be coming. We've highlighted the euro's proximity to massive longer-term resistance off the 2008 record high, and we've discussed the pound's rocketing plus 600-point upside extension since breaking the 2017 high that has already reached its objective in remarkable time. So there is a good case to be made for an end to the one-way dollar drain. While the worst of Brexit is out of the way, there are still plenty of bumps to expect here as well, and with all quiet on that front since December, we'd expect some more drama at any moment, which could easily undermine the pound. As far as today's calendar goes, key standouts come in the form of UK GDP, Canada CPI, US GDP, and US durable goods. Away from FX, keep an eye on that US equity market melt-up, and keep an eye on the price of Bitcoin, which has been a little too quiet and very capable of working its way back into the headlines at any moment. That's all for now. Have a good weekend.